Hey everyone, I'm back from my short break, and as you can see, I'm at a new location. Thank you so much for your patience and sticking around and all the well wishes during my short break here. So, in this video, I'm going to look at Alphabet, Amazon, and Alphabet and decide and answer which one is the best AI stock to buy right now. I'm going to compare these three on their cloud revenue, or what I see as a proxy for AI revenue. And I'm going to look at their valuations using my proprietary discounted cash flow valuation models and looking at the valuation on a forward price to earnings basis. I'll do all that in this short video, so let's get right into it.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so what I have here is a chart from fiscal.ai. This is the same company as before where I was getting my data, finchat.io. And you can see AWS from Amazon, server products and cloud services revenue from Microsoft, and Google Cloud revenue from Alphabet. And starting from 2017, you can see the phenomenal growth in these segments for the respective companies. Amazon's AWS revenue has grown from 17.5 billion all the way up to 107.6 billion. For Microsoft, that segment has grown from 21.6 billion to 97.7 billion. For Google, it's grown from 4.1 billion, more than 10x to 43.2 billion. For the fastest compounded annual growth rate out of these three companies. So, seeing this excellent growth in this category, you can understand why these companies are spending hundreds of billions of dollars building out these data centers. Now, more recently, these data centers have been optimized for artificial intelligence, which is the strongest growing category of these cloud services. And so, these three are benefiting from strong demand from consumers. And in fact, all of them in their most recent conference call statements, the management teams have said that they would have generated even more revenue in these segments if they had more supply, if they had more capacity to serve the customers that are looking to buy these services from their product offerings. And so you can reasonably assume that these three segments will continue growing for these companies. So now that we've looked at the segment revenue for these three, let's look at valuation. And what you're looking at here is my proprietary discounted cash flow valuation calculation. And Alphabet, its intrinsic value per share to be worth $204. The current market price is $176. So you can get Alphabet stock at a reasonably undervalued valuation at the current market price. Of course, the biggest risk with Alphabet right now is changing consumer behavior in the search category, which is threatening its Google search business. And so that's the primary reason you're able to buy Alphabet stock at this lower valuation. Amazon, I also calculated a discounted cash flow valuation for, and that value for Amazon stock came to $233 a share, and Amazon's current market price is $214 a share. So you can get Amazon stock also at an undervaluation. The biggest risk for Amazon stock investors right now is how the business will be impacted by rising global tariffs. Of course, most of the products sold on Amazon's e-commerce platform are imported goods, but thankfully, those are most of the products sold in the United States. Thankfully, Amazon has an international business, and suppliers that source products overseas can sell to customers outside of the United States, and Amazon can focus its supply chain to source more locally for US customers. And so, given the size and scale and diversification of the business, it has some mitigation strategies towards those tariffs, but they are still a big risk to the business, both in the near and long term, if there isn't a resolution that favors Amazon's international suppliers. And then we have Microsoft, and I calculated the discounted cash flow valuation for Microsoft, and that intrinsic value per share came to $438. The current market price is $476 per share. So out of the three, Microsoft stock looks the most richly valued when measuring on my discounted cash flow valuation. But that's not the only way I look at valuation. I also like to look at the forward price to earnings ratio. And again, I'm getting this chart from fiscal.ai, formerly finchat.io. And when I look at the forward PE valuations, Microsoft and Amazon look similarly valued at forward price to earnings around 34, while Google or Alphabet looks cheaply valued at a forward price to earnings of 19. And again, that goes for the reason for that significant undervaluation is because of that big threat to Google's search business. But it's trading at a more than 33% discount to Amazon and Microsoft. So I like all three of these companies, and two out of the three I actually have rated as the best nine stocks to buy right now. And those two are Amazon and Google. And so with Amazon and Google, I would say it's very close. And I would say Amazon and Google are a better value right now than Microsoft. But if I had to pick only one out of these three, I would pick Alphabet. And in fact, I have picked Alphabet. Alphabet is the one out of these three that I own. And then I would rank Amazon next and then Microsoft in third place of these three excellent AI stocks to buy. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.